Please welcome to the show, Bill Baruch of Blue Line Futures in Chicago. Bill, I kind of teed that one up for you because I know that you're kind of a macro guy, or at least I think you are. Maybe you're not, but I think you are. Where do you stand on what the recipe for success is while we're sitting here talking about maybe 6 rate hikes in 1 year, an overbought or a very high stock market? There's going to be some pitfalls, and I'm afraid that that's going to catch some people at the wrong time.
Yeah, we can already see the way this year started out that we're not in that 2020, post stimulus run up, not that 2021 run up anymore. This reminds me a bit of the turn of 2015 and 2016. Rallies are going to get sold into at least for a bit. Maybe the S&P has to work down to test the 200-day moving average. You have the expectations building for the rate hikes. I don't think they're going to get to how many they do expect, but even today, they've increased those expectations, the rate futures have, and they're expecting a May hike, a second hike in May at a 50% probability.
Well, I mean, the pundits over the weekend were talking six quarter percent hikes this year. I'm going to keep saying that all week long. I think that's a tall hurdle to get over, because on all of my workings with the Fed are not personal, but I'm watching them do what they've done over the last 35 years. They just don't do anything quickly, right? And I can't imagine them raising rates every other month so they can get 6 in. I mean, heck, it's going to be March before maybe even the first one anyway. So when I talk like that, where do you lie when it comes to how many rate hikes we're going to get this year? And I know that's not a fair question, but assuming everything stays the same, what would you be expecting, or what are you talking to your customers about?
You said it. The Fed doesn't do anything quickly. At least they try not to. And this is why we're here right now. They should have begun this taper, announced it at the latest at Jackson Hole in August.
Absolutely.
And we wouldn't be in this situation right now. If they had done that then, we would have gone through the taper at the start of the year. We might have hiked in December. It's with the fact that they didn't want to face this, this sort of distortion among the employment right now. And now they are. And now you have inflation that's really coming in hot. Overall, I expect liftoff to March. I don't expect a second rate hike until June. You're already seeing GDP numbers start to come in. I think it was Atlanta Fed GDP after that retail sales miss on Friday. Business inventories on Friday is something I want to be watching very closely moving forward. That number on Friday was a November number, but I think with bad retail sales, you're going to start to see inventory bulk up. It's going to weigh on GDP, and you have to find stocks that have good earnings. You have to find stocks that are not too expensive, and it's not going to be a growth market. And that's especially my younger clients. I'm really holding their hands because they're calling me last year and saying, why aren't you in Roblox? Why aren't you in this stock? And I'm really trying to explain that, listen, we're going to be making this transition right now that you have to have the value stocks. But even today, you're seeing banks get hit, and that's because Goldman missed earnings, and then the yield curve is flattening very heavily right now. So, it's one of those markets you're going to stay on your toes. You're going to have to just sort of the white knuckle period, hold hand through it, and there's going to be value that's going to be found. This is the type of year that you can really make the next 2 to 3 to 5 years, and really become very, just find really good positions and build out from there.
Two things. I'll start with, you're exactly right. And maybe this is a down year. Let's just say it's off 10%. I don't know. But if you can come through that at flat, you're in such a better spot, going into 2023, number one. I think that's key. But number two is you mentioned something which I think a lot of people, the red mist comes down over their eyes and they don't want to understand. But I want you to make it as simple as possible. That 2-year interest rate, that 5-year interest rate, that 10-year interest rate, that yield curve you just mentioned. Can you explain as simply as possible how that matters? Why do you watch that, and why a flat yield curve might be telling you something, or maybe even inverted one?
Listen, if you look back at the end of 2019, the yield curve, which is the difference of the short ends against the long ends, specifically the 2-year against the 10-year, right, that inverted. That means growth is going to slow. It's pricing in a Fed that's moving too fast right now, and those rate hikes, they're not going to be coming later on because growth is going to slow. So I want to really kind of tell you to look at it from a standpoint of that the rate hikes themselves are going to slow growth, and the growth is already slowing. So a yield curve is telling us the Fed is hiking, the flattening yield curve is telling us the Fed is hiking into a slowing growth period. And that's not good. That's not good for the economy right now.
And that's a double whammy. So when you tell the investors, or our listeners and our viewers out there, inverted means that 2-year interest rate gets to be higher than that 10-year interest rate, correct?
Correct. Yeah, the 2 years higher than that 10-year, and that distorts the movement of money. I mean, just to put it that way, plain and simple, it distorts the movement of money across from banks, financial institutions, and what it signals is that growth is slowing, and that's been the precursor to slowing growth. Look at the end of 2019 when the Fed ramped up those rate hikes, and then Fed Chair Powell, ahead of Q4, was saying quantitative tight. They did the quantitative tightening. He said it's an autopilot, and then the market didn't like that because the market and the economy knew that growth was going to be slowing, and the Fed was tightening into that. And we had a 20% sell-off, and the Fed had to start easing policy immediately.
Yeah, and that's one of the things I'm worried about this time around. And I think that it's great that you brought that up. Our viewers should know that when you start to get that yield curve flat, then maybe even when the front or those shorter dated things get to be more expensive as far as interest rates go, that's not a good thing, especially if we're talking about raising rates in the short term at the same time. And that's going to curtail growth. And then ultimately, Bill, that can make them not have to do 6. They might only have to do 3 because everything's falling down around them. So again, I love what Mike Tyson had to say. Everybody's got a plan until you get punched in the face, right? So that could be the case. All right, Bill Baruch from Chicago, Blue Line Futures, thanks very much for coming on the show today.